Okay, chapter 5 is video number 3. It starts talking about historical records and portfolios and just some different stock indexes and areas that trade markets where stocks are traded. And first talks about the world's largest stock, which is 24 developed countries and 6,000 stocks. Those are the big stocks in the world. The U.S. stocks, the large stocks, are Standard & Poor's, those are the largest 500 largest cap. The 500 largest market cap, which you find, if you don't know, from taking the stock price times the number of shares outstanding. The U.S. small stock, the smallest 20% on the NYSE, the NASDAQ, and the Amex. The world bonds, same countries as the world large stocks, and then the U.S. Treasury bonds like Barclays long-term Treasury bond index. And then it goes into looking at the averages. Now this is an average over a very long period of time. 90 years, 1927 through 2016. But it does give you the arithmetic average, and it gives you the risk premium. Now notice on this table here, we talked about this in the last video, the arithmetic average in T-bill is basically where we've got almost zero risk. Okay, so there wouldn't be a risk premium on that, or at least as close to zero risk as we can find. So notice that if you take the arithmetic average and you add the risk premium, you should get the arithmetic average of the new column. So the risk-free is 3.42 in this case. 2.08 is the risk premium on a T-bond if you took and it's obviously rounded by 1.01, but 3.42 plus 2.08 is 5.5, which roughly gives me that number there. Similarly, if you take the 3.42, again, there's a rounding issue, but 3.42 plus the risk premium 8.48, you get the stock arithmetic average of 11.91. This is just a chart showing the historical records and returns on T-bills. Notice that it's almost always 0 to 5 most of the time. There's been a few times when it's been 5 to 10, very few times it's been 5 to 15, and even fewer times it's been 0 to -5. Treasury bonds, a little bit more skewed. We have almost a bell curve here, not quite, but close. Looks like we have a little bit of ketosis maybe on one side, but we see that the average generally stays within the 0 to -5 to the 10 to 15 range. Overall, that would be probably about my standard. Well, let's go back to where standard deviation is. Standard deviation for Treasury bonds is 8.14. So that means that roughly 95% fall within 0 and -8.94 and positive 8.94. Oops, sorry, let's go this way. I was on the wrong one. Between -0.89 and positive 0.8, which makes sense looking at this chart. It does look like that's the case. And then we have our equity market index. And you see that's a little bit more up and down. You got some years where you've got all the way down to 40 to 45. So you can see this is much more risk, and that's why it has the highest risk premium of the group. All right, asset allocation. Portfolio chooses, and you choose among broad investments. You have kind of a lot of options on where you can invest. The complete portfolio is the entire portfolio, including risky and risk-free assets. Capital allocation is our choice between risky and risk-free assets. So how much risk do we want to take on, and how much do we want to be risk-free? Obviously, the risk-free ones return less, generally speaking, but also are more likely to return some. So a lot of times with our portfolio, we take a balanced approach to that. So a risk-free asset is something like a treasury bond, although that is still affected by inflation. Price index government bonds are also considered a risk-free asset. Money market instruments effectively risk-free, so money markets. The risk of CDs and commercial paper is minuscule compared to most assets, so CDs and commercial paper also pretty much virtually risk-free. So an expected rate of return on portfolio, this is on page 131 over on page 132. We have our expected return for the complete portfolio is what we're looking for, where our expected return of the risky portfolio plus 1 minus the risk-free, one minus the percentage of assets in the risky portfolio times the risk-free assets. looks really complicated, but effectively all we're doing is we're taking our risk-free and we are adding that to our risk analysis based on the percentage of assets in each one. So we've got the percentage of assets that are risky and the percentage of assets that are not risky or less risky or risk-free. And we're adding those two numbers together to get the complete expected return of the portfolio. And it goes on to say that our standard deviation of that portfolio is found by taking our percentage of assets in the risky portfolio times our standard deviation for our risky portfolio of the risky portfolio. So this is an investment opportunity set with a risky asset and a risk-free asset. So you'll notice that the risk-free asset, which would be, remember right here, the risk-free asset is RF. So RF here, the risk-free is where we are at 7%, where our riskier assets. Let's see here, risky. Expected return of the risky portfolio, so the riskier assets is up here at the 22%. So my risk versus my risk-free, I've got an 8%. That would be my risk. If I was on that chart, that would be my risk premium. Oops, sorry, going through a lot here. So that would be my risk premiums. This 8% difference here. Capital allocation line, CAL, plots the risk return combinations available by varying allocation between risky and risk-free. Risk aversion and capital allocation, where Y is my preferred capital allocation. So our available risk premium to variance ratio versus our required premium risk to variance ratio. So this is another formula that's effectively saying a lot of times we're planning for investments. If we're working on our own behalf, obviously we can kind of make this decision on our own. If we're working on behalf of a client, most of the time we have a form or some sort of, well, I don't want to say a test, but it kind of is to find out what their risk aversion is, and we put that, we kind of standardize that, and we put it on a scale of most risky to least risky, and then we can assess what their desired needs are and what they want based on how much risk they're willing to accept, how risk averse they are versus how risk accepting they are, and that's where we would use this, and we'd say our available risk premium. How much can we use? How much are they willing to use up of that risk premium based on how risk averse they are versus how they are, whether they are or aren't risk averse. Okay, passive strategies. Passive strategies are investment policies that avoid security analysis. So where we kind of just let the market do what it wants to do. Capital market line, capital allocation line using the market index as a portfolio as a risky asset. So passive strategies usually involve investing in either risk-free assets or investing in indexes where our risk is effectively whatever the market is doing in the first place. So costs and benefits of passive investing. Passive investing is inexpensive and simple. The expense ratio for active mutual funds averages 1%, so it doesn't cost you much. Why? Because there's not very many decisions being made. If I'm just buying mostly index funds, if I'm buying, S&P 500 or NASDAQ or Dow Jones Industrial Average index funds, that quite simply means I'm just buying assets that are in those funds. So there's not a lot of decisions being made, so that means there's not a lot of expenses. The expense ratio of hedge funds averages 1 to 2 plus 10% of the returns above the risk-free rate. So hedge funds, while they return a lot more, you can see they have a much higher expense rate. Active management offers a potential for higher returns, which is true, but you're also, it's a matter of whether those higher returns hold enough value to cover the cost of the expenses that the hedge funds often require. And that is it for video 3, and that's all for chapter 5.